The next topic in finance of AS2 is cash flow and cash flow forecasting. So cash flow is the term used to describe the flow of money into and out of a business. It is, of course, the lifeblood of a business, as its circulation is essential for a business to survive. Cash is constantly moving through and around a business. It comes into the business from sales and loans and leaves the business to pay for, of course, materials, labour, marketing, interest payments on loans, etc. So what is the importance of cash flow to a business? If a firm has enough cash, then of course it's able to pay its bills. But if it runs out of cash, then they may be forced to close because creditors will want their money and may force them to close and sell off their assets to get that money back to them. If a firm has enough cash, then it will not have to borrow money, like taking out overdrafts, for example, to pay bills. Overdrafts, as we know, are expensive, and we've looked at that in our sources of finance topic, and there is interest charged on them daily at high rates. So they are costly to pay back. If a firm has enough cash, then it obviously is able to pay its employees. And of course, if you haven't got enough money to pay your employees, and of course buy your stock from your suppliers, you can't actually operate or trade as a business. So cash is extremely important, and it really is all about how efficient you are as a business in terms of managing your day-to-day cash. However, it is also important for businesses not to hold too much cash. Now, why would that be? Well, cash on its own does not generate any revenue. If it's sitting idle or sitting in a bank account as a current account, doesn't generate revenue, it's not earning you anything. So if there's too much cash in an organisation, it needs to be put to work. Okay, so put into a deposit account or into an investment where it's going to gain interest and earn something from. Or indeed, if there's a lot of cash sitting, then maybe they should be using the cash to invest in assets or technological development, which would actually turn over greater revenue for the business in the longer term. So again, holding cash is critically important to pay your bills, but holding too much cash is also an efficient financial management issue within a business. Many businesses suffer from cash flow problems, and in order to try to avoid this happening, there are a number of things a business could do. So what could they do to be better at controlling their cash flow? Well, one, avoid too much trade credit. Now, what that means is, again, trade credit is a source of finance we've looked at. You should not, be giving customers 90 days to pay back what they owe you, and then you pay back your suppliers every 30 days. It needs to be the opposite scenario. So you need to be getting your money in quicker from your customers, the other businesses, before you're able to pay back your suppliers. So allowing the trade credit balance needs to be right between, coming in and going out. Secondly, you need to ensure good credit control. That means that you have an accounting system in place with an admin team of accounting technicians, etc., who are going to chase money that is owed. So there has to be a recording of information, good system to record, what's owed, everything is invoiced up, and obviously reminders sent prior to payment dates, and then follow-ups to payment dates if they're not adhered to, etc. So a tight and efficient credit control system. And thirdly, what is very important is good, accurate cash flow forecasting. So it, of course, is not going to be the case that you always get your forecasting 100% accurate, because again, you're forecasting and there's always going to be subject to human error and changes and things happen. But there should be a forecasting process that takes place. In other words, the business is looking ahead and anticipating months where money flowing out, may exceed the intended money flowing in revenues, and then putting measures in place to be able to deal with that. Now, what's very important, and this comes up very regularly in a 4-mark question, what is the difference between cash and profit, the concepts of cash and profit, and then maybe show an example from the case study. So you'll be going to look at your information and picking up with a reference to cash or money in the bank, and then looking at something to do with the revenues and costs figures to get a calculation on profit. So cash, as we know, is physical money. It's a physical amount of money held in a business, in a bank, or indeed in the cash tills. The difference then with profit is an accounting calculation. It simply is a calculation. It does not indicate physical money whatsoever. Okay, so of course a business can survive without making profit for a short period of time, but it's an essential that you are in a positive profit calculation on a longer period of time. But day to day, you must have cash. Okay, so cash is physical, profit is not. And secondly, why they are different is that the calculation of profit includes non-cash expenses such as depreciation, whereas depreciation is not an actual physical flow of money leaving the business, but it is an understanding and a recognition, okay, as an expense on your income statement that you're accounting for, okay, assets that have lost value, and you're simply recording that loss of value. It's not an actual physical movement of money. Okay. The calculation of profit also does not include the purchase of any non-current assets like vehicles or machinery. Okay, we do not put the purchase of those through the income statement where we calculate profit. That's actually recorded on our financial position. So the actual calculation of profit, which takes place on the income statement, okay, is excluding very many things that of course are recorded on the financial position in terms of the assets value of worth or the liabilities that it owns. Okay, so theoretical ways then, okay, on how to improve cash flow. So a good cash flow is important because it ensures that business has a steady supply of cash to pay essential bills. It also gives us a good reputation for paying on time. And cash flow is important because it ensures they don't need to borrow as much money. So how might a business improve cash flow? What kind of things can it use to improve its cash flow management? And again, some of this is replication of what we looked at in terms of sources of finance. So number one, it could use a bank overdraft. Okay, I'm not going to go into details of those that are sources of finance. 2, it could use a short-term loan. 3, it could speed up its cash inflows. Now, what does that mean? That means negotiating shorter trade credit from your customers. So, if you originally had an agreement of a 90-day repayment from your customers, maybe renegotiating that's taken back to 60 days, tightening, okay, your relationship in terms of speed back to 60 days, so money is coming quicker back to you. Okay, factoring, okay, also as a way of improving cash flow. We looked at that, so cash injection, and then obviously paying back the money to the factoring company after you receive your invoice totals from your customers, okay, minus the fee they charge. Selling off assets, again, possibility, not probability. Not too many businesses have non-current assets idly lying around that they're not actually using. And all of the assets that you have, you're using them for a purpose in the business. So it's not just that easy to sell off something. Sale and lease back of assets, leasing, okay, or renting rather than buying. And that's very common to try to have good cash flow management, that you lease or rent rather than purchase it outright. Negotiating longer credit time off your suppliers. So it's the opposite of it's trying to speed up your inflows or negotiating reduced time for repayment from your customer. You're actually negotiating on the other side a longer time from your supplier. Now there's a fine balance between that. Again, if you get your money in quicker from your customers and you're negotiating a much longer period of time to pay your suppliers, you need to understand that when you've got the money in, you need to manage the money. You can't be spending the money carelessly then because you've got the money in, and then come the longer time to repay your supplier, say 90 days or 120 days later, you actually don't have the money any longer. So again, that takes fairly tight control and efficiency within your accounts department to manage the cash well. Okay, and lastly, managing inventory more effectively. So again, as we know from production and production theory, inventory costs a lot of money. Holding too much inventory takes up a lot of space, so that's money. And of course, inventory that is brought in large quantities not only does take up space, but what happens if demand changes before you use the inventory, and then you don't actually need the inventory and you have lost value. Or particularly if it's perishable goods and you can't use it quickly enough or sell it quickly enough, then you're never going to get this full value back. So, okay, it's very important, okay, to look at your level of inventory control and how you're holding it. Now, the importance of cash flow forecasts, okay, again, theoretical question, might be an 18-mark question, the usefulness of cash flow forecasting, or a 10-marker, analyse the importance of cash flow forecasting. So, here are some points that would be important to consider. Preparing a cash flow forecast is a valuable planning procedure. It allows the business to put into place strategies to deal with any forecasted negative cash flow, such as organising an overdraft or an extension to its existing overdraft facilities. Secondly, it enables the owner or manager to plan the business's expenditure. Perhaps a machine has to be replaced during the year, while other expenses such as electricity always have to be paid, for example, at regular intervals, maybe even quarterly. Recording all forecasted expenditure enables the business to see if these payments would result in cash shortages at certain times. Thirdly, cash flow forecasting can be used for helping business set prices. So if a particular period of time in the year, you know your costs or expenses are significantly higher, that might be a period of time that you might nudge your prices up slightly to allow access to a little bit more inflow of revenue. Okay, if the forecasted sales revenue indeed is low, the marketing team may consider promotional pricing indeed, or a particular promotional activity to try to boost sales revenue. So again, linking in with the marketing department and their actions within the marketing plan can help in terms of good cash flow forecasting. Suppliers also may want to see your figures in cash flow forecasting to assess if the business will be able to pay you for what they're going to give you. So again, setting up a new contract with a supplier, they may want to see the historical evidence from your business that you're good with cash management, that you have good cash control, that you can manage your cash well and be able to pay on time. So they may look for this historical accounting evidence. And then also a cash flow forecast sets targets for the business to work towards. And at the end of the period, you can then see what actually happened. So again, it allows it to be used as monitoring and evaluating purposes. What did we think was going to happen with our cash in and out in months? What did actually happen? And then that allows them probably to plan a little bit tighter for a subsequent period of time in the business's activity. Okay. The drawbacks of cash flow forecasting then is that obviously it takes time to plan it, research it, plan it, and work out figures. Okay, and again, some bias can set in with that depending on who is planning the cash flow forecasting. The finance director might be over ambitious, indeed might be quite prudent. Okay, so based on their personality, might depend on how realistic or accurate the cash flow forecasting might be. In contrast, what if you don't have an expert cash flow person or a finance person, and they don't have the expertise to be able to do that kind of work to help the business plan? Then you have to employ someone from outside, and of course that is further adding to your business's costs. Now, in terms of an evaluation on cash flow forecasting and the usefulness of cash flow forecasting, again, you're going to present the examiner with an advantage and counter-argue it, again a disadvantage and counter-argue it, and then again maybe an advantage, counter-argue it, and then overall you're making your judgment. But again, the context of the case study is very important, not just rhyme and theoretical knowledge of cash flow forecasting, but really think about the business you're reading. How important is this business to have good cash? You think about why it needs cash to be able to pay, and what needs to pay, and is it a small business or a large business, and what are the problems if it would become cash short, etc. So just look at the context of the business and integrate as much of your case study into your arguments, okay, as possible. Now, again, they might ask you from the angle of improving cash flow. Okay, how might they improve cash flow? So again, back to all of those sources of finance, and again, suitably selected based on the context of your business. From the perspective of the calculations, what might they ask you to do? They could ask you to complete a very basic cash flow forecast statement or read some figures from it. And as you know, it would be maybe a 3-6 month forecast statement, and it will list inflows, total your receipts or your inflows. Then it'll list outflows, or payments it can be called as well, and you total them. And of course, the inflows minus the outflows gives us what we call, the net cash flow position. And net cash flow then added back to the opening balance of that particular month's opening balance becomes the closing balance for that month. And then we carry the closing balance for that month across to the opening balance of the next month. So again, this is theoretical understanding from GCSE, no different, exact same cash flow forecasting process that we looked at back at GCSE. So again, what might you do? Calculate missing figures on a cash flow statement, forecast statement, or indeed, looking at it from an analytical point of view, how to improve cash flow, the importance of cash flow, or the significance of cash flow to a business.